Yep, it's like buying Pepsi, water, orange juice and a Red Bull because you're thirsty. You've diversified your flavours, but really you just need hydration.
Welcome to Heart of Wealth, your weekly pulse check on the wealth industry. I'm Sophie Downs, your host for this week. Today on the show, advisors hit a trust wall over £1 million model portfolios. We look under the hood of the active ETF boom to see what wealth managers are actually buying. And finally, how Agentic AI is quietly taking over fund selection. Joining me to unpack this are two Citywire journalists, Gilbert and Nour, and Raymond James CIO Patrick Farrell. So welcome to the studio, everyone.
Thank you, Sophie.
Thanks for being here.
Jack, let's start with you. So you recently hosted a advisor roundtable where you were talking about MPS. What were some of the big findings?
Yeah, so we did a roundtable. We talked about advisors' investment propositions. And one of the interesting things that came out was a couple of advisors said they wouldn't put all their clients into one MPS. They'd say they'd layer them across multiple ones. One of the advisors, Andrew Elson, said for a £1 million client, he would do 400, 400 and 200,000. And that was really just to kind of spread the risk. They said that all these MPS providers are not the holy grail, and using multiple providers means they can spread the risk, and if one of them performs well 1 year, they can draw more money out of that for their clients, and if one of them's done badly, they can draw less out of that for that year for their clients as well.
And we had some quite interesting comments underneath the article. So how did our readers feel?
Most advisors in the comment section were saying that actually you should stick with one MPS provider, and using multiple ones kind of adds complexity to it. So Amir Roshalima left a very interesting comment and said, "We do not believe clients are best served by layering one model portfolio on top of another in the hope that more moving parts automatically means better outcomes. In practice, it can create unnecessary complexity, overlapping holdings, higher costs, and diluted accountability. Simple is not unsophisticated. Simple done properly is what gives clients the confidence to stay invested." And Stuart Edwards said, "Yep, it's like buying Pepsi, water, orange juice and a Red Bull because you're thirsty. You've diversified your flavours, but really you just need hydration." So yeah, most advisors were kind of saying in the comment section certainly that maybe just stick with one MPS provider.
And all very unhealthy drinks. First stage.
I'm thinking, is that
too much sugar?
Yeah, right? Is that going to keep you hydrated?
No,
I'm not sure.
I mean, Pat, what's your sense? Is this kind of advisor caution really justified here? Do you need to be splitting a 1 million pot across different providers?
I think any sort of diversification is good, but it needs to be managed. So if you're buying one provider and you're buying exactly the same thing in a different provider, then are you diversifying appropriately? So, and I do think that there is an element where you sort of say, know what you're buying, know where you're getting some of that sort of differentiation coming through. I think that's the most important thing in any investment lesson.
Well, I suppose whatever kind of vehicle people use, the bigger question is what's actually going into these portfolios. I mean, Nour, so you spoke to 3 UK fund selectors about the active ETF space in particular. What did they tell you about what they're actually buying?
So we had our ETF retreat last month, and we had a panel. And essentially what they said is that, the 85 billion euros that's gone into active strategies in Europe is just a mirage. It's not active per se. We've got the US. We always compare the US and Europe. And you've got in the US, everyone is obsessed with sort of high conviction, sort of high octane stock pickers. It's an unfair comparison. We've got we had the panelists who were from AJ Bell, from EFGI International and Evelyn Partners, and even the delegates who actually voted during the course of the event, saying what's really clear is that the money that's flowing is flowing into the systematic, low cost sort of quant strategies that mix man and machine. It's not pure active, it's the shy sort of active. They're buying products that are essentially hugging the benchmark. So we're talking about 1.5% to 2% tracking error, and that's what they want. And that's where the money is flowing.
And what's your sense? Is this really about finding better returns, or is it kind of a clever way to cut client costs?
It's a bit of both. I think they want predictability, and they want a steady strategies that's going to give them exactly what they want. They don't want to reinvent the wheel. Like we said, in the US, they've got this tax incentive, so it helps that you invest in ETFs, whereas in Europe, we don't have that same idea. And so it makes sense that you've got all these high-shot star managers creating all these strategies in the US, because it helps, and it's absolutely fine. So they, for example, this morning, what was really interesting is that we had an exclusive Robeco ETF range crossed 2.3 billion euros in assets in just 18 months. So 18 months after entering the active ETF market in Europe, they've reached that. But the volume of money is actually not going to these high conviction sort of active, strategies. It's actually going to their quant 3D strategies. So that's man and machine once again. And so for European investors, people that we speak to, people that were at the event as well, the selectors, they don't want expensive risks or big bets. They just want predictability, and they want benchmark sort of aware strategies that slightly hug the benchmark, but have that active tilt to it.
Pat, you were nodding away there. I saw.
I think absolutely spot on. From a European cultural perspective, I think a lot of the active ETFs that you're highlighting there, they're more indexed enhanced.
Yes.
They're trying to sort of just get that edge, but a lot of active managers don't necessarily want to release their USP. They don't want to actually have a live portfolio out there. And whereas in the US, the culture is, as you say, it's a different mindset as to the way that a US investor will accept an active ETF, and therefore the demand is there, the liquidity is there. But in the European sort of space, it's only just sort of building. We're only building that culture up to that point. So it makes sense that it starts off on that enhanced piece, but then in time, it'll probably build.
It's a gateway. I mean, one of the panelists actually said it is a gateway to having that full active eventually. But for now, we're going to continue to see these strategies coming to the market that are just enhanced, a little bit active. So, but it's a different industry altogether.
Do you think the active managers are worried about withdrawals from retail investors affecting performance?
I don't think it would be a liquidity sort of situation, right? So I think that they'll be able to manage it. They're not necessarily playing in that small cap space where liquidity is an issue. But I think until they sort of get the demand from their underlying investors to say, I want an ETF, and understand that from a European institutional investor base, they're mainly pension funds, and they're big, strong pension funds. They want their own mandates in order for that to happen. I think the retail base just isn't quite there yet. They're happy to take on more indexed enhanced, probably because passive products have done so well and continue to do that. So there just hasn't been that demand for the active piece coming through.
Yeah, absolutely.
Well, let's move on to our final story. So a new Citywire selector survey shows that AI use has surged across the board internally, with over a fifth of top European fund selectors now adopting Agentic AI for their work. What does AI look like at Raymond James?
To start off with, very cautious. So, making sure that all of our client information is completely and utterly sealed. That's absolute paramount. And I would say that our parent in the US spends $1 billion in terms of technology. So, and a lot of that is just in relation to cybersecurity, but also the AI, but making sure that we do it in the right way. So that's one thing. From a research investment perspective, we use it quite extensively, and we will continue to sort of use it. And then for our advisor base, actually accessing our research, being able to create the chatbots that then they can actually look at our library of research and essentially know exactly where to find things in an instant. That will be brilliant from my perspective, because I just won't get all these calls coming through. Can you tell me this and can you tell me that? So I think, that will be very, very helpful.
But that's coming down the track, that's not there yet.
It's in development, very much so, but it is literally just around the corner for that to happen. I think one of the interesting things that you sort of highlighted there, though, in terms of fund selection, I've got a fund selection team, and if I told them I'm going to replace you with Agentic AI, they would just be gobsmacked. But I would never do that, simply because if you're talking to a manager or a fund, it is the people that are making those decisions. And there is almost that sort of emotional intelligence piece that I don't think AI can interpret right? So if they're talking, you know, the guys will be able to sort of see if the manager's a little bit unsettled or uncomfortable about talking about a particular sort of situation. That's golden, right? Because that means that's where they dig, that's where they sort of find out a little bit more information.
Mm-hmm. So it won't get to a point where fund selectors are kind of validating the AI shortlist?
I think, yeah, eventually we'll get to a point where there won't be any differences between the managers if that's the case. Mm-hmm. If everything is so driven by a systematic approach, then there won't be any of that sort of fear or greed that potentially drives markets. And so, you know, from that perspective, volatility should actually come down a little bit overall. But I think, yeah, from a fund selection point of view, as long as people are still making those decisions, then there is still that element of that human interaction, which I think is going to be really important.
Well, I think that's all the time we have for today. So thank you everyone for joining. A massive thank you to our production team and to our guests, Patrick Farrell, Nour, Azhar and Jack Gilbert. Thank you for watching. We'll see you next time.